$65 billion. 40 years. One man. Bernard Madoff. For 13 years, not a single real trade. For decades, this was the most trusted name on Wall Street. Its returns never seemed to fail. Paper trail. Case 1. The $65 billion lie. For decades, he was one of the most respected men in American finance. Bernard Madoff had once chaired the NASDAQ exchange itself. Few men on Wall Street carried more credibility. He had helped found the NASDAQ market, and once served as its chairman. But high above the trading floors, on a separate, quiet floor of a Manhattan tower, something else was running. To investors, it all looked like Wall Street royalty. Quiet wealth, and steady, effortless growth. The money came in slowly at first. A few $100 million, from investors who trusted the name. His pitch was a strategy called split strike conversion. Steady returns, 10 to 12%, every single year. Ordinary families handed him their savings. The statements always arrived on time. The numbers always went up. But real markets rise and fall. Madoff's returns only ever rose. No legitimate fund performs this consistently. Not ever. You couldn't simply invest with Madoff. You had to be invited. And that was exactly why people trusted him. By the mid-1990s, the total had passed $7 billion. On the 17th floor, there were no real trades. Only old computers, and a printer running all night. Every month, investors received detailed statements. Every trade on them was invented. Here, the returns were manufactured. Fake statements, printed on period-accurate paper, aged to look real. Each confirmation slip described a trade that had never taken place. Sealed, stacked, and mailed out by the thousands. A paper trail of trades that never happened. By the 2000s, the operation had scaled past $20 billion. So how was none of this caught? Here is what should have stopped it. Normally, an independent custodian holds the assets, and an auditor confirms them directly. But Madoff was the broker, the custodian, and the record keeper. There was no one independent to check. A real back office checks every trade against the exchange. Madoff's numbers were only checked against his own paperwork. A real back office verifies each trade against the exchange. His were verified only against himself. The auditor's job was independent verification. There was simply no independent party to call. And the firm auditing tens of billions of dollars? A 3-person office, in a strip mall. The firm auditing tens of billions. 3 people. 1 active accountant. $65 billion in assets, signed off by a 3-person shop. 1 analyst saw it coming. Again and again he warned regulators. And again, he was ignored. 1 analyst sent the SEC detailed warnings, for years. They were filed away. By December 2008, the total read $65 billion. And there was nothing behind it. Then came 2008. Markets collapsed, investors wanted their money back, and there was nothing behind the numbers. When the crisis hit, investors asked for their money back faster than new money came in. In a quiet apartment, the truth finally came out. $65 billion. All of it, a lie. On December 11, 2008, Bernie Madoff was arrested. It was the largest fraud in Wall Street history. He would never walk free again. In June 2009, he was sentenced to 150 years. The most trusted name on Wall Street would die in prison. The fraud was simple. It was the paperwork nobody checked. The rules changed after him. Surprise audits, third-party checks, stronger oversight. But the damage was done. Tens of thousands of victims, across the world. The fraud wasn't the lie. It was the paperwork nobody checked. Paper trail. Where money goes when no one is watching.